The next financial crisis has already started. That is the warning billionaire investor Ray Dalio has been giving in recent months. And according to him, most Americans still don't understand how serious the situation could become. When people hear the words financial crisis, they often think about a sudden stock market crash, bank failures, or a dramatic economic collapse that appears overnight. But history shows that major crises rarely begin that way. Instead, they build slowly beneath the surface for years. Warning signs appear one by one. Debt rises. Governments spend more than they earn. Interest costs increase. Investors become nervous. And then eventually, a trigger exposes weaknesses that have been growing all along. According to Dalio, America may already be in the early stages of that process right now. For decades, the United States benefited from a unique position in the global economy. The U.S. dollar became the world's reserve currency. Investors around the world trusted American financial markets. Government bonds were considered among the safest assets available. This allowed the United States to borrow enormous amounts of money while maintaining confidence from global investors. As long as the economy continued growing and borrowing costs remained low, the system appeared stable. But Dalio believes the foundation supporting that stability is beginning to crack. The issue isn't just how much debt America has accumulated. The issue is how quickly the debt is growing and how difficult it is becoming to manage. Today, the U.S. national debt stands at levels that would have seemed unimaginable just a few decades ago. Every year, the government spends far more money than it collects through taxes. To cover the difference, it borrows even more. During periods of low interest rates, this strategy appeared manageable. However, now that interest rates are significantly higher, the cost of maintaining the debt is rising rapidly. The government is spending hundreds of billions of dollars annually simply to pay interest on money it already owes. That means less money is available for infrastructure, healthcare, education, defense, and other priorities. According to Dalio, this creates a dangerous cycle where debt generates more debt. One reason Dalio's warnings attract so much attention is because he studies history. He doesn't just analyze stock markets or economic reports. He studies the rise and fall of civilizations, empires, and financial systems. After examining hundreds of years of economic history, he noticed a pattern. Great powers often experience periods of prosperity followed by excessive borrowing. Eventually, debt levels become so large that maintaining them becomes increasingly difficult. Governments are forced to make painful decisions. Political divisions increase. Economic growth slows. Financial instability rises. The process may take years, but the pattern repeats throughout history. Dalio believes America is approaching a stage where these historical forces are becoming impossible to ignore. He often emphasizes that debt itself is not the problem. Debt can be useful when used responsibly. Businesses borrow to expand. Families borrow to buy homes. Governments borrow to invest in infrastructure and economic growth. Problems emerge when debt grows faster than income. At that point, the borrower becomes increasingly dependent on new borrowing just to maintain normal operations. According to Dalio, that is exactly what is happening in the United States today. The bond market sits at the center of this issue. Most Americans rarely think about bonds, yet they influence nearly every aspect of the economy. When the government needs money, it sells treasury bonds to investors. Investors buy these bonds because they expect repayment with interest. But if investors begin worrying about America's debt trajectory, they may demand higher interest rates to compensate for the increased risk. Higher rates increase government borrowing costs. Those higher costs lead to larger deficits. Larger deficits require more borrowing. The cycle feeds itself. This creates a serious challenge for policymakers. If they cut spending aggressively, economic growth could slow. If they raise taxes significantly, consumers and businesses may spend less. If they continue borrowing without restraint, debt levels rise further. None of the options are politically easy. This is one reason Dalio believes America may already be entering the early stages of a financial crisis. The problem isn't that a collapse is guaranteed. The problem is that the available solutions are becoming increasingly painful. Inflation is another major concern. Throughout history, heavily indebted governments often face pressure to create more money. While this can provide temporary relief, it also reduces the purchasing power of existing currency. Americans have already experienced the effects of inflation in recent years. Prices for food, housing, insurance, healthcare, and everyday necessities have increased dramatically. Even when inflation slows, prices rarely return to previous levels. Families are forced to spend more just to maintain the same standard of living. Dalio warns that inflation acts like a hidden tax. Most people focus on their salary, but what matters is purchasing power. If wages increase by 3% while living costs rise by 6%, people effectively become poor. This is particularly challenging for retirees living on fixed incomes. It also affects younger families trying to save for homes, education, or retirement. Over time, inflation quietly transfers wealth away from savers and toward borrowers. Another factor making the situation more dangerous is political division. Throughout history, financial stress often leads to social and political conflict. Citizens become frustrated when living standards stagnate. Different groups blame one another for economic problems. Compromise becomes more difficult. Governments struggle to implement long-term solutions. Dalio frequently points out that internal conflict has accompanied many historical debt crises. While America remains a strong nation, political polarization has clearly increased in recent years. The global economy is also changing. For decades, the United States enjoyed advantages associated with having the world's dominant reserve currency. Countries around the globe held dollars and U.S. Treasury bonds as safe assets. This created constant demand for American debt. However, some nations are exploring alternatives. While the dollar remains dominant today, Dalio believes investors should pay attention to long-term trends. Reserve currency status is a privilege, not a permanent guarantee. History shows that reserve currencies eventually change as economic power shifts. Meanwhile, geopolitical tensions continue rising. Competition between major powers is intensifying. Trade relationships are changing. Supply chains are being reorganized. Military conflicts and regional instability create additional uncertainty. In a world with high debt levels, even relatively small disruptions can have outsized consequences. A system under pressure becomes more vulnerable to unexpected shocks. Many people assume that financial crises begin with stock market crash. Dalio argues the opposite. Stock market declines are often symptoms rather than causes. The underlying causes usually involve deeper structural problems such as excessive debt, declining productivity, monetary instability, or weakening confidence. By the time markets react dramatically, the foundation may have been deteriorating for years. What makes this warning particularly important is that financial crises rarely announce themselves in advance. Most people continue behaving normally until the evidence becomes overwhelming. During housing bubbles, investors believe prices will always rise. During debt booms, governments assume borrowing can continue indefinitely. During periods of prosperity, risk feels distant. Then suddenly, confidence changes. Investors become cautious. Lending slows. Economic activity weakens. Problems that seemed manageable become urgent. Despite these risks, Dalio does not believe panic is the answer. In fact, one of his most consistent messages is the importance of preparation. Economic cycles are normal. Markets rise and fall. Financial systems evolve. The goal is not to predict the exact date of a crisis. The goal is to build resilience. Individuals who understand risk are often better prepared to navigate uncertainty. than those who ignore warning signs altogether. For investors, this may mean diversification, concentrating all assets in a single investment or asset class increases vulnerability. Dalio has long advocated balancing portfolios across different economic environments. The future is uncertain, which means flexibility and risk management become increasingly valuable. For families, preparation may involve reducing unnecessary debt, increasing savings, developing additional income streams, and focusing on long-term financial security. While individuals cannot control government policy, they can improve their own resilience. Small decisions, made consistently over time, often provide significant protection during economic downturns. Businesses face similar challenges. Companies with strong balance sheets, manageable debt levels, and adaptable business models tend to perform better during periods of uncertainty. Those dependent on cheap financing may struggle if borrowing costs remain elevated. Economic stress often separates strong organizations from weak ones. Perhaps the most important lesson from Dalio's warning is that financial crises are rarely caused by a single event. Instead, they emerge from multiple forces interacting simultaneously. Debt, inflation, interest rates, political conflict, global competition, and declining confidence can reinforce one another. Each problem alone may appear manageable. Together, they create conditions that become increasingly unstable. According to Dalio, the next financial crisis may not look exactly like 2008. Every crisis is different. Some involve banks, others involve governments. Some are driven by inflation, others by deflation. The details change, but the underlying patterns remain surprisingly consistent. Excessive debt eventually creates pressure. Economic imbalances eventually require correction. Confidence eventually gets tested. The reason Dalio says the next financial crisis has already started is because he believes many of these forces are already in motion. Rising debt, higher interest costs, fiscal deficits, inflation pressures, political divisions, global tensions. None of these are future possibilities. They exist today. The question is not whether these trends are real. The question is how far they will go and how policymakers respond. America remains one of the most innovative and productive economies in the world. Its institutions remain powerful. Its financial markets remain influential. These strengths should not be underestimated. However, history teaches that even strong nations must address structural weaknesses before those weaknesses become overwhelming. Ignoring problems does not eliminate them. It merely allows them to grow. As Ray Dalio sees it, the coming years could represent one of the most important economic periods of modern American history. Decisions made today may influence the country's financial future for decades. Whether the outcome is a manageable adjustment or a more severe crisis will depend on leadership, discipline, and the willingness to confront difficult realities. His message is not that collapse is inevitable. His message is that warning signs are already visible. The next financial crisis may not begin with a dramatic headline tomorrow morning. It may already be unfolding quietly through debt accumulation, rising costs, weakening purchasing power, and growing financial stress. By the time most people recognize the full scale of the problem, the easiest opportunities to prepare may already be gone. That is why Dalio believes Americans should pay attention now, because in his view, the next financial crisis isn't coming someday in the future. It has already begun.